Hey everyone, today in our chapter 12 video, we're going to go over the design of the tax system at a very high level. As you may or may not know, the tax system has changed a lot over the past 200 years. Now, while tax rates have gone up and we've changed how we collect those, whether through primarily tariffs or through an income tax system, it has changed. And while tax rates are up compared to 200 years ago, I do question who would rather live in 1789 versus living in the 21st century. I would rather live now personally. Some states and localities have experimented with changing the system, especially with lowering the rates, whether it's a New Hampshire libertarian experiment or the Kansas experiment of 2012, but those have had mixed results, usually disappointing results that get reversed. You can see here graphs showing approximately how much revenue is collected as a percentage of GDP by the federal government, and then how much is on top of that through state and local additional taxation. In our discussion, we're going to talk about what does it mean to be efficient and equitable. Efficiency here, we will use the minimizing deadweight loss as a measurement. And then equitable, what it means to be equitable means different things to different people. We'll be using the lens of an economist here. In the era after World War II, deficits, public debt remained existent, but not terribly high until the 1980s, where wartime spending during a period of not real war, we had the Cold War, but tax cuts and increased military spending and entitlement spending had the debt growing at a consistent rate over the next couple of decades until the financial crisis of 2008, and then increased fiscal policy spending had the deficit grow dramatically as we try to pull out of the Great Recession quicker than other countries. And you can see here when COVID pandemic started, it had a dramatic, just an insane increase in the national debt. And now we've gone back to the previous high trend, which is not really sustainable. But this paints a picture of just how things have changed. This picture shows that a little differently. Here it shows the federal budget surplus or deficit, which is the annual budget gap or surplus. Going back to the 1960s, you can see here the surplus was much greater. I mean, not the surplus, I wish. The deficit was much greater, deficit decreased, and then the deficit dramatically increased during the COVID pandemic and the response. So I hate debts and deficits. We're going to have to pay for it eventually. Debts now are borrowing against future generations' earnings. Here you can see the percentage of income that governments take in by various countries, going from most, well, maybe not most, but more to least, just out of the dozen or so countries that are listed here. You can see the United States falls here at 26%. That's 20% less than Denmark, which may be more or less than you expected. I should have probably had you pause and consider where you think the US might fall. Not only have government expenditures increased, but the ways we collect taxes have changed. So I mentioned tariffs. Back 200 years ago, there was a debate on whether tariffs should be meant for protectionism or just revenue increasing. There were the intolerable tariffs. I think it's called something like that. That led to the nullification crisis under Jackson. Then those were reduced to revenue tariffs under James K. Polk. So you think about what we get from the government for the amount of taxes we pay, and you can compare that if you look up what some of the other services that other countries get, whether it's free education in countries like Germany or free healthcare in the United Kingdom or Canada. What they get, they pay a little bit more in taxes, but then they get these additional services that we do not. That all plays into how happy the citizens feel in the country. Now, the people in Denmark may pay more taxes, but they also feel relatively happy. So there are many different happiness metrics you can look up. By one, the United States citizens have a happiness index of 6.73, but compare that to Denmark, 7.58, despite paying 20% more in taxes. So why might that be the case? Well, maybe it's because they get services that we do not get here. We may pay lower taxes as a percentage of income, but we may make up for that by spending our income on services that they get from the government. So whether that's education or healthcare. If the difference if we pay 20% less in taxes, but then pay 30% for those services, are we getting a bargain, or uh, the people in Denmark have it better off? That's not a question I can answer, but it is something to consider when you're thinking through policy decisions and what you prefer. When you get a job and they're told your salary is, say, $100,000, you're going to think through, let's say that job requires you to move states. Well, your salary, if you're offered $100,000 in Minnesota versus $90,000 in Florida, you have to consider, or you may want to consider, how that gap is represented by what goods you get, etc., but also by the taxes. So if you're in Minnesota, you may get taxed more. So even though your salary may be $10,000 more, you may lose that same amount by the additional taxes. But maybe you just really want to live in Minnesota. Maybe you really want to live in Florida. Unfortunately, our high school system doesn't really teach many people about taxes. I know that when I was in high school, and for some weird reason I knew about marginal tax rates, I got in trouble for correcting my teacher when they said, "Oh, I have a higher salary now, so I'm going to make less because I'm in a higher tax bracket." That's not at all how it works. But the teacher didn't know that, and I got sent to the principal's office. You're going to be concerned with deductibles. Deductibles will reduce how much you owe by the percentage that you would have been taxed on that amount. So if you get a deductible of $1,000, or you take the standard deductible, $7,000 or whatever, you're going to be taxed. You're not going to be taxed on $7,000 of your income. But if you get a $7,000 credit, then you get $7,000 refund from what you would have paid in taxes. Credits are much better for you as a taxpayer. Uh, when you are taxed, your marginal tax rate, we talked about marginal a lot during this course. Marginal is thinking at the edge. So you're only going to pay the amount of the higher tax bracket on the amount of your income that falls into that specific tax bracket. That's why getting a raise will never make you end up getting paid less overall unless you lose some benefit, which that discussion would go into the poverty trap discussions. There are different kinds of taxes. Your payroll taxes that the employers pay, well, it's shared between the worker and the employer. Social Security, I note here that it's not putting away money in a personal retirement account for you. It's a social insurance program, so that if you end up having to file disability claims, you have some money in there. But also, if you're older and need to retire, there's some money there for you. But you paying taxes today are paying for the benefits of the people that are retired right now. Social Security was not pre-funded, so that makes its solvency a question. So you'll hear the need for reform discussed frequently, whether it is raising the retirement age, removing the cap, because people's income is only taxed up to a certain level for Social Security. So if you make $200,000 a year, only the first, say, $110,000 of that is taxed for Social Security purposes. The rest of it escapes that tax, which some people consider regressive. There is a corporate income tax, which taxes corporations on their profits. Some people consider this double taxation, because then when those profits are passed along to the corporation owners or stockholders, then they are taxed again. but those are generally taxed at lower capital gains rates. I had been saying for 2 decades that the corporate income tax rate could be reduced as long as the capital gains rate was increased so that it would be revenue neutral. Unfortunately, the 2017 Tax Cut and Jobs Act did decrease the corporate tax income rate, but it did not raise the capital gains rate. There are many people, even wealthy billionaires, who call for capital gains to be taxed as ordinary earned income. But again, some people complain that that would be double taxation. There are other taxes that can come about, like Pigovian taxes, to solve negative externality issues. There can be customs duties. All tariffs are duties, but not all duties are tariffs. There's the estate tax, or you can hear wealth tax, discussed as policy opportunities. Then there are sales taxes that can be collected by the state or local governments, which can vary by type. So you may pay a lower sales tax on food as a necessity, where you may pay higher tax on alcohol. That can be used to deter certain behaviors or simply to generate revenue. Sometimes you'll hear there are tax holidays that can be used to spur spending. You may say, okay, here's a tax-free holiday, and then suddenly everyone buys their big ticket items like a car or a new appliance or TV. Uh, Gas taxes vary from state to state. You can see Illinois has a fairly high gasoline tax uh, compared to, say, Louisiana at 20 cents per gallon, a little bit closer to Indiana. But you can also sometimes tell that those states with lower gasoline tax may have worse roads. I know that when I was on Interstate 20, leaving Louisiana and going to Texas, I could tell when I left Louisiana and entered Texas because the roads suddenly got better. There is the expression, you get what you pay for. Some taxes can be tied to specific line items in the budget, saying all of this tax will go toward a specific thing. Sometimes they are not. If you ever want to look into the US federal government and look up how much specific programs cost or what percentage of the US budget is for this specific thing, like NASA or military spending or SNAP benefits, you may be surprised. Typically, people think the big ticket items are a lower percentage of the budget than they are, and people think the smaller ticket items like NASA are a much bigger percentage of the national budget than they really are, because they're typically much smaller. All right, let's go ahead and pause for the quick quiz. Question 1, as a percentage of national income, taxes in the US are B, lower than in France, Germany, and the United Kingdom, based off of what I showed previously. And then question 2, the two largest sources of tax revenue for the US federal government are B, personal income taxes and payroll taxes for social insurance. The back of this book, this chapter in the 9th edition, incorrectly lists this as D, but that is incorrect. You have to look at the update in the 10th edition, show the correct answer is B. That's because property taxes do not factor into federal tax receipts. So answer B matches what table 1 a couple pages back had. I want to bring up here that in my chapter 8 discussion, I brought up the Laffer curve. And if you think about the Laffer curve and then you think about the graph here, do you think any of these countries with higher taxes are to the right of the peak of the Laffer curve? If you lowered taxes in any of these countries, do you think you would generate more tax revenue? Some people think that's the case. My personal guess is probably not. I think these countries, their marginal rates are probably to the left of the peak, but that's not a unanimous decision among economists. I'll keep on bringing up deadweight loss. We've talked about how taxes change incentives on behavior, so it can distort some activity. It can create deadweight loss, though things are not as simple as many of the initial labor economics discussions indicate, because not everyone can 100% control how many hours they work at jobs. If they offer you a salary, you can't say, well, you know what, I'm going to work 20 hours instead of 40, they're probably going to fire you and find a full-time employee. Not everybody is a contractor that can say how many hours specifically they're going to work. So the labor supply may be sticky with respect to that. So here we go over one person values a pizza at $16, another at $12, and they charge $10. So we think about consumer surplus. First person has $6 of surplus, the other person has $2 of surplus, for a total consumer surplus of $8. But if the price of this item, the pizza, is suddenly increased by a $4 tax, the effective price is now 14. Person number 2, Carmen, is no longer a buyer at that point, and the first person, their consumer surplus reduces from $6 to $2. So the total consumer surplus goes from $8 to $2, and the $2 and the tax revenue is $4 on that one pizza. So you have your $2 of consumer surplus, $4 of tax revenue. Compare that to the original $8 of consumer surplus that we had. That's a $2 gap that has evaporated in surplus. So that $2 represents deadweight loss. So since we are discussing the design of the tax system, we're going to continue discussing different tax setups. For example, there are income taxes versus consumption taxes. Income taxes make earning less attractive because your earnings are taxed. So the higher the taxes, the less you're earning instead of just staying at home. So it discourages earning and incentivizes stimulating the economy through buying. So it can help now by having people spend and stimulate the economy, but it can hurt later when people don't have money saved up. Consumption taxes, however, for example, like a value added tax, makes purchasing less attractive because you have to spend more because you have your item price and then the tax on top of that. So imagine you want to buy a car and then suddenly they say, oh, by the way, now you have to pay $1,000 on top of the purchase price in taxes. That's going to make you less desiring of spending that money on a new car. So that encourages saving. So that can hurt now and help later. It can discourage demand created for products because they're going to be taxed, so they're going to have their demand decrease. Value-added taxes like sales taxes. Value-added taxes are like sales taxes, but they are collected at the point of sale. The sales taxes are collected at point of sale, but the VAT are collected along the stages of production. You can switch tax systems, but that can hurt people that planned under the existing system based off of certain tax incentives and how they save based off of current and future taxation. If you switch systems, it can hurt the people that have already planned under the existing system. So that's something you have to factor in when you talk about changing systems. Is it fair or equitable to people who have worked under the previous system? Tax systems also have to consider the administrative burden, not just on the government by having to require an IRS and auditing, but also on the filer. So you'll hear discussions about whether there should be a free tax filing system, which companies like TurboTax lobby Congress against. We had a system, and I think that has been recently lobbied to be eliminated, which is going to raise the cost to file taxes for many of us. Now we're going to go through some terms. We've got average tax rate, which is the total taxes paid divided by the total income. Compare that to the marginal tax rate. So I've talked about this, the amount by which taxes increase from an additional dollar of income. So marginal, we're always thinking at the edge, the additional amount. Then lump sum tax, so a tax that is paid is the same for everyone. So you hear lump sum taxes, you'll hear flat taxes. If you watch the debates from a previous decade, You hear some candidates talk about, oh, we need a flat tax so we're all paid the same. That sounds equitable. But if you get into regressive versus progressive systems, that can be considered fairly regressive. Sorry, I noticed a typo I just fixed. Um, if you hear me talk much about the marginal tax brackets, you may hear me frequently discuss the progressivity of the 1954 tax code. And while people aren't generally expecting us to go back to that, compare that to what we have now. I invite you to look that up, the progressivity of the 1954 tax code and how many tax brackets we had. I think there were 22 instead of the 3 or 5 we have now. And they went up pretty high. But remember, you were only taxed at the amount that fell into that tax bracket. And you may also consider how the country did from 1954 to the next 30 years. Also contrast, if you paid a lump sum of $6,000 in taxes every year, and so did Elon Musk, would you feel like your $6,000 was the same as Elon or uh, Bezos' $6,000? They can lose $6,000 and not even notice. I would notice if I lost $6,000. Let's go ahead and pause for the quick quiz. All right, question 3. Betty gives piano lessons. She has an opportunity cost of $50 per lesson and charges $60. She has 2 students, Archie, who's willing to pay $70, and Veronica, who is willing to pay $90. When the government puts a $20 tax on the piano lessons and Betty raises her price from $60 to $80, the deadweight loss is blank and the tax revenue is blank. The answer is 20 and 20. I'll go into that in greater detail in the next slide. Question 4. If the tax code exempts the first $20,000 of income from taxation and then taxes 25% of all income above that level, then a person who earns $50,000 has an average tax rate of A, 15%, and a marginal tax rate of 25%. That's because 25% of $30,000, or the 50K minus exempted amount, is 7,500, and that divided by 50,000 is 15%. And the marginal tax is 25% for amounts above $20,000. Lump sum taxes, A, have a 0 marginal tax rate, plus the next dollar of income isn't taxed at a greater amount. So let's work out question 3. So eventually we had the producer surplus, which is $60 that she charges minus the $50 of opportunity cost. Archie had a consumer surplus of 10, so that's the difference between 70 and 60. Veronica's consumer surplus was the difference between 90 she was willing to pay and 60 she was paying. So that total surplus was 10 plus 10 because she's charged 2 people, and then $10 from Archie and $30 from Veronica, so $60. However, after the $20 tax is implemented, Betty raises her price from 60 to 80. Her producer surplus formula remains unchanged, still 10Q, but we're going to lose a customer in Archie who's not willing to pay the new price. So his consumer surplus drops to 0. The Q changes from 2 to 1, and Veronica's consumer surplus decreases by $10. Government revenue is $20 based off of the one quantity that's still transacted. So producer surplus is 10. So the total surplus is 0 from Archie, 10 in producer surplus, $20 in government revenue, and $10 from Veronica, so 40. So the initial surplus minus new surplus was 20. So that is the deadweight loss. The answer is C, 20 and 20. So discussions on taxes and equity are challenging. Obviously, we don't have a perfect system, and these issues are debated to infinity, nonstop. Different people have different ideas, different priorities. disagreements on to what extent returns are diminishing and how the taxation can impact the economy. So, how do we consider how the tax burden should be allocated? Do we use the benefits principle, which is the idea that people should pay taxes based on the benefits they receive from the government? Do we use the ability to pay principle? So taxes are people are taxed according to how well you can shoulder the burden. So if you have more, you can suffer the burden of taxes greater than someone else. Do we use vertical equity? So the idea that taxpayers with a greater ability to pay should be uh, should pay larger amounts. Uh, Maybe this is because of diminishing marginal utility. So that's you have, if Bill Gates sees a $5 bill on the ground, he may not pick it up, but maybe my 7-year-old will, because different amounts of the same dollar amount can mean different things to different people. Or do we use horizontal equity? Those with similar abilities to pay should pay similar amounts. You'll probably want to reread those definitions a few times to pay attention to what the key words are to know how each are different. So greater ability to pay, similar ability to pay. Also, it's questionable who has similar versus different abilities to pay. If we both make $100,000 a year, but I have 3 kids and you don't have any, do we really have the same ability to pay even though we make the same amount? Or do I have a lower ability to pay because I have kids? And to what extent does that even matter? Because maybe that was my choice to have kids and you chose not to. Why should you be burdened with that? Well, that's a question for society to entertain. We're not going to discuss what is right here. We're only going to walk through how people have these discussions. Additional terms you'll hear in these discussions, to what extent different systems are proportional, regressive, or progressive. So proportional tax systems have how high and low income people, taxpayers, pay the same fraction of their income. In regressive systems, high income people pay a smaller fraction of their income than low income people. If you ever hear billionaire Warren Buffett talk about taxation, you may hear discussions on the Buffett rule, which talks about the minimum tax rates, so making sure that people above a certain income don't pay a lower tax percentage than other people. Warren Buffett has said he pays a lower tax rate than his secretary due to the regressive nature of some taxes. Compare that to progressive systems where high income taxpayers pay a larger fraction of their income than low income people. So one idea is here is, like I mentioned earlier, $1,000 to me or you isn't the same as a $1,000 to Bill Gates. We talked about each additional unit of something you value less. That's diminishing returns from something. Same thing is true with dollars. So someone may have worked really hard to make their first $1,000,000, but making their second million may not be as valuable to them as their first million. And that's part of the idea behind progressive tax systems. Also, some say they get greater benefit from government expenditures because government expenditures have paved the way for us to have the system that has allowed them to make so much money, whether it's property rights or national defense, etc. If you look here at table 5, the quintiles of the burden of federal taxes may surprise you and could come up on questions. So you hear me use the word marginal nonstop, and here we are again. But when we look at certain economics books and discussions, you'll hear like Samuelson's 48 book on economics talks about people getting paid their marginal productivity. So how much should you get paid for the work you do? So if you got a product that sells for $100 and your work added 50% of the value of that product, should you get paid $50? That's sort of, when in competitive markets, when we drive towards zero profits and people paid what they're worth, that's what those models would indicate. You'd get paid maybe 50% of that. But what we're seeing now is that maybe markets aren't so competitive, so the allocation of those gains aren't going necessarily proportionally to the people making those gains. So maybe you contribute $50 in value to that supply chain, but you only pay $25. Well, as you study economics, as you study capitalism, you're going to see that it is more efficient than other systems at allocating scarce resources, but it can break down when you go to distribute those gains. And that's where even capitalist economists talk about, okay, this can be a failure of the market that can be addressed by the government through redistribution within the capitalism framework. And such as the one I mentioned before, through horizontal equity is $100,000 of income the same to two different people? To what extent does that matter based off your choices? We talked about the different, some of the different tax systems. You could have luxury taxes beyond just plain monopoly. They can be designed to generate revenue. However, they may not generate the amount of revenue that you expect, partially because of deadweight loss. Let's say you try to tax a good like a yacht that maybe has very elastic demand. So a little bit of tax can generate a huge decline in quantity sold. That can create a lot of deadweight loss instead of generating any revenue for the government. And it can also harm the people that were making those yachts and have a detriment by creating job loss. So let's go ahead and pause for the quick quiz, questions 6 through 8. Question 6, a toll is a tax on its citizens who use toll roads. This policy can be viewed as an application of the benefits principle. A, because it only taxes those who benefit from using the road. Question 7, in the United States, taxpayers in the top 1% of the income distribution pay about 30% or D percent of their income in federal taxes. And question 8, if the corporate income tax induces businesses to reduce their capital investment, then C, workers bear some of the burden of the tax. So that's like when I talked about taxing yacht builders or yacht purchasers. So tonight, maybe if you can't fall asleep, think through this lesson and think about if before you were born, you were to design a tax system, what kind of things would you take into consideration? If you didn't know whether you were going to be born to a wealthy family or a poor family in Mississippi, if you didn't know if you were going to be gifted physically with any special talents or ability to do things like play math, or if you play math, play sports, or if you were going to be good at math or not, what kind of system you were going to be born into, how would you design that system? How would you design incentives to generate the kind of activity that you want to generate? And what would be the consequences of that system you would generate? Would it generate more economic activity? Would people work more? Would they work less? Either of those, are they good or bad consequences of your system? What do you want? Because generating a tax system is complicated, and not only are people going to have different goals they're trying to achieve, but they can disagree on whether or not their system can achieve those goals. So remember, it's reasonable for people to disagree if they have different priorities, but you should use what you've learned here to have good discussions in good faith about what potential outcomes could be your systems. So there we go at the end of the chapter. Let me know if you have any questions.